Okay, let's talk about one of the most powerful patterns in all of stock trading. What if you could actually see a stock getting ready for a huge move, just by looking at its chart? Well, today, we're going to break down the anatomy of exactly that, the cup with handle pattern.
I mean, that's the million-dollar question, isn't it? Everybody wants to know the secret. But the thing is, it's often not some secret tip. It's about learning to read a visual pattern that shows up over and over again. This isn't crystal ball stuff. It's about understanding market psychology.
Just look at this chart. Yeah, that massive spike on the right is what gets all the attention. But the real magic, the real clue, is the formation that happened right before it. That beautiful, distinct shape is the cup with handle, a pattern first made famous by the legendary investor William J. O'Neill way back in 1988.
So, how does this thing actually work? What are we really looking at? Let's start with the basic blueprint, the visual anatomy of the pattern itself. Okay, bullish continuation pattern sounds kind of technical, but all it really means is that a stock that's already in an uptrend is just taking a healthy pause. Think of it like the market just catching its breath, shaking out a few nervous folks, and getting ready for the next big sprint higher.
So the pattern really has three key parts. First, you need a strong uptrend already in place, like at least 30%. Then you get the cup, which is that big rounding consolidation. And finally, you get that little dip right at the end, and that's the handle.
Now this is absolutely crucial. The shape of that cup matters a lot. You want to see a nice rounded U shape. That tells you the stock is building a solid, stable foundation. But if you see a sharp V shape, that's a huge red flag. It's way too volatile and suggests the move might just fall apart. And this really gets to the core of why this pattern is so powerful. It's not just some random shape. It's actually a story about human emotion, a visual map of the tug of war between fear and greed in the market.
It literally tells you a story. It's a tale of the early birds taking their profits, of the big, institutional, smart money quietly buying up shares, and then one final little shakeout to get rid of the last few nervous sellers right before the stock takes off.
So, let's break that story down. It happens in 4 acts. Act 1, profit-taking forms the left side of the cup. Act 2, the smart money moves in at the bottom, creating that rounded base. Act 3, the handle forms, shaking out the weak hands. And for the grand finale, with all the sellers gone, the stock is cleared for takeoff. Boom!
Okay, so we get the what and the why. Now it's time to get practical and talk about the how. This is where we move from theory to a real, data-backed checklist. This is what separates pure guesswork from a high-probability trade.
This is where the rubber meets the road. Look, professional traders don't just wing it. They have a checklist, and this is it. On the left, you've got the ideal characteristics you're looking for, and on the right, those are the warning signs telling you to stay away. These little details, they make all the difference.
First up, let's talk numbers, the depth of the cup. Ideally, you want to see a pullback of about 12 to 33%. If it drops much more than that, say over 50%, the stock might not be just resting, it could actually be broken. Next up, time. And this is a big one because you've got to have patience. A really solid cup pattern doesn't just happen in a week. It needs time to build that strong base, usually anywhere from 7 weeks to sometimes over a year. But the handle? That's a completely different story. You want that to be quick and tight. We're talking 1 to 4 weeks max. It's that final, fast shakeout right before the big move.
Okay, now listen up, because this might be the single most important confirmation signal of them all. Volume. A real legitimate breakout has to happen on a huge surge in trading volume. We're talking at least 50% above normal. That's your proof that the big institutions are jumping in with both feet.
All right, we've done all our homework, we've checked all the boxes. Now we get to the most exciting part, the climax of the whole pattern. It's go time. Let's talk about how to actually execute the trade.
This is it, the moment of truth. Your ideal buy point, what traders call the pivot, is that exact moment the price breaks above the high of the handle. Think of it like the starting pistol firing for the next race up.
And this comparison right here tells you everything you need to know. On the left, look at that massive explosion of volume that confirms the breakout. That's what a winner looks like. Now look at the right. The price tries to move, but on pathetic, anemic volume, and it fails almost immediately. Volume is your lie detected.
Every disciplined trader has a game plan. It's super simple. You need to know your entry point, right above the handle. You need to know your exit if you're wrong, a stop loss just below the handle's low. And you need a target if you're right, which you can estimate by adding the depth of the cup to your breakout price.
Okay, before we get too carried away planning our victory lap, we need to hit pause for a quick reality check. Because in the real world of trading, nothing, and I mean nothing, is ever foolproof.
You have to remember that real-world charts are messy. They rarely look as perfect and clean as the textbook examples. You're going to see shallow cups, you're going to see sloppy handles. The key isn't to find a perfect picture. It's to understand the story of what's happening and always manage your risk.
And speaking of reality, context is king. The overall market trend has a huge impact on how well this pattern works. Check out the data. In a healthy bull market, the average gain is about 34%. But in a bear market, that drops down to 23%. It just proves that old saying, the trend is your friend.
And hey, don't just take my word for it. This stuff is backed by tons of research. As the expert Thomas Bulkowski puts it, the pattern's real magic is that it signals a strong stock is just taking a rest and is getting ready to resume its climb with some serious force.
So, at the end of the day, the cup with handle is really just a map of market psychology. It's a story of fear slowly turning into greed, of weak investors giving up and selling to stronger, more patient ones. Learning how to read that story can give you an incredible edge. So the real question is, what story are your charts telling you?